This is a very uncertain time that we're living in. I mean, investments are acting weird. Nothing seems to be performing well. Headlines of inflation everywhere you look. And because of this, I've been spending a ton of time learning about inflation. And this has led me to a 2009 recording of Warren Buffett talking about his top 2 methods to ride an inflationary wave without too much pain. However, in typical Buffett style, he packs a whole lot of information in just a few words. So I wanted to do my part here and show his top 2 methods in battling inflation and break each one down further into terms that are easier to digest. So let's go ahead and start with the very first method.
The best protection against inflation is your own earning power. If you're the best teacher, if you're the best surgeon, if you're the best lawyer, whatever it may be, you will command a given part of other people's production of goods and services, no matter what the currency is, whether it's seashells or Reichsmarks or dollars. So your own earning power is the best by far. If you're the best journalist, whatever it may be, you will get your share of the national economic pie, regardless of the value of whatever the currency may be as measured against some earlier standard.
Now, I want to go back to a line that Buffett said and analyze it for a minute. He said, if you're the best, you will command a given part of other people's production of goods and services, no matter what the currency is. Now, what does this mean? This means that there is always a need for the very best work. And this is because there are different types of customers. First, there are people who want a job done cheaply and don't really care much about quality as long as the job is done. As long as the job's done, they don't care. Maybe there's a few issues. Maybe they have to do some micromanaging, but they don't care. They want to pay the cheapest price possible to get that done. And then second, you have those who want a job done cheaply, but desire high quality work. This is the worst customer to have. And anyone who's owned a small business or offers a service knows these types of people. You don't want to service these people. That's the second kind of customer. And third, you have those who want a job done perfectly and don't really have much regard for price. They are willing to pay more to have something done correctly for the first time and without thinking about it. Or they're willing to pay more for the best version of something. These people typically don't have the time or the energy to make sure that everything is being done properly, but they have the money to hire the very best person to make sure that that job is done properly. These customers lean more towards what's called inelastic demand in economics. This is where the demand of a good or service doesn't decrease quite in line with raising prices. Basically, if the price goes up, sales are not very affected when there's inelastic demand. This is typically attributed to necessities, things like food or clothing. However, it's also true for the highest quality version of something that people are willing to pay more for. Now, on this chart, we can see the difference between elastic demand and inelastic demand. With elastic demand, we can see that the quantity demanded of some product or service decreases as price increases. Now, we typically see this kind of demand in products that have a strong alternative. For example, if Jiffy Peanut Butter or Porsche cars increased their price 5x, demand for those products would surely shrink some amount. Now, a perfectly inelastic demand curve means the price of a product could go infinitely high and demand would not decrease at all. This, of course, doesn't really happen in real life. However, you can think of some dystopian future where, there's only 1,000 gallons of water left on the earth. And because of this, the price of water could theoretically be infinitely high because there would still be demand for that limited resource. But I don't think that's going to happen anytime soon, but we'll see how 2021 pans out. So all this economics talk gets us to one simple point, that if you are the very best at something, or more realistically in the top few percent of your field, you are able to demand multiples higher than your lower quality competitors. And you're able to do that without demand for your work decreasing dramatically. And this is exactly how a top architect like Norman Foster gets paid $2.7 million a year when the median architect wage is $82,000 a year. Now let's go back to Buffett and see his second way to battle inflation.
The second best protection is a wonderful business. If you own the Coca-Cola trademark company, you will get a given portion of people's labor 20 years from now and 50 years from now for your product, and it doesn't make any difference what's happened to the price level generally, because people will give up 3 minutes of labor, 5, whatever it may be, to enjoy, 12 ounces of a product they like. So those are and those are the great assets, your own earning power first, and then the earning power of a wonderful business that does not require heavy capital investment. If it requires heavy capital investment, you get killed in inflation. And with those guidelines, I would tell you the best thing to do is invest in yourself.
So Buffett says the second best way to battle inflation is to buy stock in or have ownership in a wonderful business. Now, this is true firstly because of the same reasons a top performing individual doesn't really need to worry much about inflation. When there's demand for a specific product or service, when it's valued highly, people will pay for that thing despite changing external factors like the dollar becoming worth less and less over time through inflation. This means a company with a very strong brand and reputation can raise their prices in a high inflationary environment before their competitors do. And the great company can raise their prices knowing full well that demand for their product will remain high, or at least be affected less than their competitors. This ability to raise prices first can be the difference between a profitable year or not during a particularly high inflation period. Looking back into history, we can see inflation was very bad in the 1970s and early 80s, with CPI increasing more than 10% in some years. In fact, it was so bad that between 1971 and 1981, the real return for the S&P 500 was a negative 16% after adjusting for inflation. This means you could have bought $1,000 worth of a nice, safe S&P 500 index fund in 1971, held it for 10 years, and after that entire decade, you were left with only $840 in relative buying power. That's what inflation can do at its worst. Now, a company that's able to instantly increase their prices by 10% when their cost of labor, their cost of equipment and supplies increase by 10% is going to fare much, much better than a company who can't. And this is the value of strong brands and strong companies. And then Buffett went on and said that no matter where the currency goes, up, down, sideways, or even if we start buying things exclusively with stamps or Pokemon cards, people who value a product will still give up a proportional amount of their labor to pay for that item simply because they value that item or they value that service. And then finally, Buffett mentions to stay away from companies with heavy capital investment. Now, why would this matter? This is because every asset your company needs to produce its product is subject to inflation and increased prices. So let's break this down with an example. We're going to take two companies, and for the sake of this example, we'll say both are equally valued and demanded. Company A is a software company, and in order to generate $1 million in revenue, they need to spend $500,000 on things like staff, office space, computers, and some basic supplies. But their product being software is very scalable. It doesn't really cost them anything more to sell 10 copies versus 20 copies. Now let's say 10% inflation comes in, and now their expenses increase from $500,000 to $550,000. This just dropped their profit by 10% now to $450,000 from their level of $500,000. Now company B is a small airline. In order to generate $1 million in revenue, they need to spend $900,000 on things like staff, maintenance, lease payments, rent, you name it, to make that $1 million in revenue. Yes, their service is scalable and valuable, but it has high costs to expand and operate. Now with this company, Company B, we have 10% inflation rolling in. This increases their expenses from $900,000 up to $990,000. Now Company B's profit just decreased 90% from $100,000 in profit to only $10,000. And that is why heavy input costs to run a business can cause huge issues when inflation is high. So in summary, we can learn a lot from Warren Buffett's thoughts on inflation. We know that if you personally offer a fantastic product or service, or you own a business that does so, your customers will continue to value and pay for your services no matter what happens in the economy or what happens to currency, or if we're trading with seashells and Pokemon cards in order to buy things. So invest in yourself, and as always, have a profitable day.